Hey everyone, it's Craig with AVR Real Estate, your Conejo Valley real estate expert. Hey, today I am here with Mike Weiss of CMG Mortgage, formerly Capstone Direct. If you guys are familiar with me, if you follow my newsletter at all, then you know I lean heavily on Mike for mortgage information and kind of what's happening in and around the mortgage industry. So I wanted to meet with Mike because he's been filling me in on a brand new product that he's got out. I was talking to him a little bit. It's actually completely unique, something I've never heard of before, and I'm really interested to kind of share it with you guys because I think it's possibly something that's very beneficial for a lot of people out there. So Mike, thanks for letting me come in and meet with you here today. You got a great spot. I love it. Happy to be here.
Yeah.
So Mike, just real quick, how long have you been in the mortgage industry for now?
Just over 30 years I've been in the mortgage industry.
So
yes, long time.
Seen pretty much all for sure, all the ups and downs.
Yes.
So Mike does a great job. He's located out here in Newbury Park, just off Old Conejo Road here. And if you haven't been to his place, you got to come check it out. It's actually really nice. So Mike, you're filling me in on the new program, the all-in-one loan that you guys have got going on right now.
Yes.
Fill me in a little bit on that. How is the all-in-one different than kind of what most people are familiar with the traditional 30-year fixed mortgage?
Yeah, so it's fun. I love selling this product right now. So the all-in-one loan from a high level is basically, it combines your loan, your home loan, with a checking account that we give you. And basically what happens is every night with our first lien line of credit is what it is, we go into your checking account that we set up with you and pull all of your money out of your checking account and pay down the principal balance on your mortgage. And you do this day in and day out, whether there's $1 in your checking account or there's $500,000 in your checking account. We pull all that money, and if you do that on a consistent basis, you'll pay off your loan in about 10 years, and you'll save hundreds of thousands of dollars in interest.
Wow. Okay, so back up here a second. You talk about creating a checking account that people put all, I mean, it's kind of scary to think I'm putting all my money in the checking account and you guys take it right away.
Yeah.
What if I need to pay bills? What if I need to access it in some way? How does that work? Do I still have flexibility with those sort of things?
Hence the name. That's why we call it the all-in-one loan, right? Okay, so we're combining both of them. We give you an app, or you can log into your account, and basically you will see debits, credits. You'll see your checking account has no money in it, but you'll also see that your mortgage has enough equity to be able to make any payments necessary that you might have to make. So if you have the water bill, the electric bill, whatever, and you see zero money in your checking account, don't worry, because you have equity in your home loan. And when that bill comes in to get cleared, we take the money out of your mortgage account and we pay that bill for you.
So someone can still utilize this checking account as a regular checking account that everybody has every day, write their bills on it, go shopping with it if need be.
Yeah.
They can have a debit card attached to it.
Debit card, Visa card, you can have a checkbook if you want a checkbook. You can do online banking. Do you know what a checkbook is?
I do, sadly, but...
Yes.
Phone's ringing. Let me turn that off. Sorry.
That's okay. So basically, yeah, it's the same checking account that you would normally have today, and it has all the features that you would normally have: online banking, debit card, the whole 9 yards.
Okay, so walk me through this. Somebody, you deposit money into it. Now it can either come from you transferring from a regular checking account, doing direct deposit into it, is that right?
Yeah, your income coming in, it could be from investments, it could be from investment properties, like you have rental income coming in. Any money that you have that you're earning that's going into that account, it will take it right out of there. If somebody Venmos you $20 because you paid for their lunch, the Venmo money comes in there, it pays down we pull it out of there and it pays down your mortgage.
So obviously you have flexibility with what you put in. Someone doesn't have to take their whole check and direct deposit in it. They can if they want, but it's not a requirement.
It's not a requirement, but the more money that you put in there, the faster you're going to pay down your loan and the less interest that you're going to pay. Let me just give you an example real quick, okay? So let's talk about, you talked about the 30-year fixed rate and how it's different. On a 30-year fixed rate mortgage, the interest on that loan, because it's a fully amortized loan over 30 years, the amount of interest that you pay in the first 15 years is over the top, way more than what you're paying down in principal. And so it's a very expensive. It's a great loan because you know exactly what your payment's going to be on the first of each month, and you know that that payment is going to be that way for the next 30 years, but it's a slow process. This process with the all-in-one loan, instead of it being a fully amortized loan where you scheduled interest payments, it's a principal first mortgage. So you're paying down principal first. So the more money that goes into your checking account, the more money is going to pay down your principal balance on your mortgage, avoiding paying as much interest as possible.
Okay, so with a normal loan, like you said, it's interest heavy on the front end of the loan.
Yep.
You write a check for $3,000, like $2,500 of it goes towards interest, and the rest might be principal sort of
exactly.
thing. So you're telling me if I understand, I put $3,000 into this checking account, it immediately hits the principal.
Yep.
And then how is the interest calculated? Is it monthly? Is it daily? Is it hourly? What is it?
So it's like a line of credit. So this is where it differs a little bit, is that it's daily interest. So we take a snapshot at midnight of every night and tell you what is the principal balance times the interest rate divided by 365 days, and that's the amount of interest that you pay for that day. We take that snapshot every day. So at the end of the month, we take 30 days of those snapshots, and on the 21st of the following month is when we actually deduct that from your all-in-one loan as an interest payment. So the days of you having a $3,000 a month mortgage payment it's a lot different than that. You don't have that on this mortgage. It is it's almost an interest only loan, but it's a principal first where you get charged less interest.
Okay, so the amount of interest you're going to pay each month could fluctuate based on how much money you deposited in, how long you keep it there on a daily basis. It'll go up or down on each day depending on if you've written money against other purchases of whatever, paid bills or whatnot. So that's going to change regularly.
Yeah. So let me I'll take that for right now. And you go basically, if you have your checking account today, money goes into that checking account where you're not earning any interest on it whatsoever, and it sits there for 1 to 15 or 20 days until you actually pay your bills. All we're doing, instead of the bank using that money to go out and loan that to somebody else, a car loan, an installment loan or whatever, you're going to take that money and you're going to lend it to yourself to pay down your mortgage so you're paying less interest. It's float money that is sitting idle in your account. And instead of it sitting idle in your account, we're paying down your balance on your mortgage to avoid paying that interest.
Interesting. So the interest will change every month, potentially, depending on how much you're putting in.
Exactly.
You're going to pay less interest over the course of the loan.
It's just going to fluctuate. And you'll have access to that on your app, watching it every single day. Okay,
I have a few questions about this. At least with my loan, I have an impound account where I pay my taxes off that.
Yeah.
Is this worked into that? How would that work now with this loan?
We do not actually have an impound account on this because what we want to be able to do, instead of having an impound account set aside for your taxes and insurance, we want to use that money to pay down the principal balance, avoiding interest. And then when your taxes and insurance payments come due, you can write a check. So you're basically saving money for a 6-month period of time until your taxes come in, and then you write your check for your taxes. So you're avoiding that interest. Same thing, paying it down. We have different ways of tricking the account as well. Similar to maybe you use an American Express card for 30 days for all of your purchases. You go buy your groceries, you go buy dinner, whatever. You put it all on your credit card, your American Express. So all of your income comes in, pays down your balance, and you're sitting over here charging your American Express card. And then on the day 2 of the month, you pay your American Express card. Then your balance goes up. But we're using that money to pay down the principal, avoiding interest.
So during that time that you're using your credit card for whatever purpose to purchase all these things, your primary funds are sitting in that account, the checking account, and keeping the interest you're charged at a lower basis for those amount of days.
Exactly, because it's daily interest.
Okay. So what happens if you decide you want to move How does the loan transfer? Is it a brand new loan? Normally, obviously, you go and you move, you start the 30-year process over again, and, and that kind of resets. How does it work with this?
So you can't take the mortgage with you.
Okay.
Okay, but what we tell people is basically you're going to pay off this loan in around 10 to 12 years. So you're gaining a whole bunch of equity by actually using this particular loan. And the sell on that is basically if you do want to move, you're creating a lot more equity faster, so that when you do sell this house, you'll have enough equity to go out and buy a new house. And we can put a new loan, a new all-in-one loan on the new house as well. But you're paying down your principal so fast that you're gaining that equity in your house. Rather than on a 30-year fixed rate, if you have a 30-year fixed rate where you're paying mostly interest up front, you're not paying your principal down enough. And even if you do, you don't have access to any of those funds. It's gone. You can't use it anymore, right? Until you refinance or sell your house. But in this case, you're paying down the principal so fast that you're gaining all that equity, and that way you can use that for the down payment on your new place.
Okay. All right. What about somebody who's like myself, for example, a commission-based earner, and I have a period of time where the summer months are great, the winter months are not as good. If I close these deals and I have these commissions that I put in and put towards this down payment, how does that work out during the months that aren't so good for me, when things go a little bit slower? What's the benefit there?
Love it. So like I said, there's no payment, there's no monthly like $3,000 principal and interest payment on this loan. If you got this loan in the summer, and let's say that you earned $20, $30, $40, $50,000 of commissions, all of that money goes down to your principal balance and it pays down your loan amount. Now you have that amount of equity in your loan to absorb any interest costs. So if you didn't put any money, it's November, December, and January, and you're like, I don't have any money going in my account. No worries, because all we're going to do is we're going to charge you that interest payment on the 21st of each month, which is going to increase your balance by that amount. So, there's actually, it's great for commissioned or highly commissioned people that earn a lot of money and then go dark for a little while and don't make as much money during
specific just to be clear, there's no set payment that has to be made every month, assuming you have equity towards the loan already paid off. So through the example you just gave, if I put multiple $1,000s in the account, I built up a supply of equity, I go dark for a few months, you're not expecting me to put money into that account.
No.
It benefits me, but it's not a have to do. It's
exactly.
A should do if you can. Okay, very interesting.
100%, that's correct.
All right. So the loan sounds great. What are some downsides of it? What should someone be concerned about if they're thinking about it?
So I'll tell you a couple of things. One is it's a variable rate interest loan. So it's a home equity line of credit. The interest on it moves day in and day out. And so in good times, the interest goes down. In bad times, like we're in right now, where the interest costs are higher, it is a little bit higher interest costs. So the interest costs can go up. But that is really the only downside of this mortgage. We've had $2 billion worth of loans, over $2 billion on this product, been sold over 18 years.
Okay.
And there's been 0 delinquencies on it. So the people that get it, they love it. I would say another negative is it is not for first-time home buyers that are like scraping money together each month. We have a little bit harder qualifying on it. You have to have reserves. And then you have to have a 42% debt-to-income ratio, whereas on a 30-year fixed-rate conventional loan or FHA loan, you could probably go up to 50% debt-to-income ratio and not have any reserves.
Now, did you mention, I can't remember if you told me or not, is there a minimum down payment with this sort of loan?
So there is a minimum down payment of 10% on this loan. It's in my opinion, it's recommended for, if you're putting 20% down, but you can put 10% down. It actually ends up being about 12% for the down payment, because of just the way the payment works and the first loan. So when you do this loan, we close the loan, we fund it, right? And then within 30 to 45 days, you're going to get information in the mail, and you're going to get your new checking account, all that information. So it takes about 30 to 45 days for it to get set up, and during that time, we need to make sure that we have enough money in there for the interest to cover. It's a little bit complicated when it gets to that,
Sure.
but it's just a transfer or setup kind of period of time, but 10% is the minimum.
Okay, well, it's a very interesting loan. Certainly something I've never heard of before. Been around 18 years, you say. It's the first I've come across it. So to review real quick, it's a principal first loan.
Yep.
You create a checking account that can be used just like a standard checking account that everyone
Normal.
uses today. You can use your debit cards. You can pay all your bills from it. You can access it. The equity that you build up through your payments towards this can be accessed at any time for whatever reason you may choose.
Yep.
There is no impound down account, so you're paying your taxes at
When they're due.
when they're due at the end
Yep.
of throughout the year, and there's no monthly payments set on it. And then lastly, the interest rates do fluctuate up and down with the ebb and flow of the market.
That's
so
correct.
right now, if you're going to buy a new home, might be the good time to get in because interest rates are hopefully at their peak. Or certainly
Yeah, I
real
hope
close
so.
to it. And as we drop down, that would allow less interest to be charged as you go through, as opposed to a traditional loan. If you lock in now, you're locked in with that interest rate unless you go to refinance, and then there could be costs and fees involved as well.
Yeah, this is a perfect example of a loan where I can tell you, like, if you get a 30-year fixed rate today in the sevens, we have a program. It's called the Rate Rebound Program, and we will refinance you for free, basically, within the next 5 years when interest rates do go down. So that's great. But on the all-in-one program, the interest rates, the cost is going to, as interest rates come down, so does the cost, and you won't have to refinance
That's
on this
great.
loan.
I mean, every time I know prior to the market dropping, I was like, I'd wait before the interest rates would drop the full point before I'd go through
Right.
the refinancing again. You get the benefit of the interest rates dropping in real time as they happen.
Yes.
All right.
So, just one more thing to
Yeah.
kind of go over with you real quick is that I do have a simulator on my website.
Oh, cool.
And so basically we can actually put your information into the simulator, and it will basically come out with, here's how much interest you're going to avoid or interest that you're going to save versus a 30-year fixed rate mortgage. Even if you have a 3% mortgage today, you know, there's an outside chance that it might be possible for you to refinance into this loan and to save some money, or, you know, maybe you save a little bit of money on it, but you still have access to all of the funds rather than on a 30-year fixed rate mortgage. They're all gone. You can't use them anymore.
Especially if you're a high income earner and you can put more money down into it, that would make more,
Yep.
some good sense. And you
Yes.
could obviously pull that money out anytime if you wanted to use it for other investments, put it into the market, put it into other
Kids
real
are going to
estate.
college, you know, medical expenses, your car breaks down unexpectedly, all those things you can write out of this account.
Well, that's great. That's a pretty awesome loan, Mike.
I love it.
I'm glad you shared that with me. Thank you
Yes.
very much. Is there anything else you want to add or anything else you want to talk about while
I
we're
think
here?
I've talked about all of
Okay,
it.
good. All right.
Yeah.
All Mike's contact information will be down in the comments. You guys can reach out to him. He's very accessible, I promise you. He's one of the few mortgage brokers that I work that actually picks his phone up when you call and calls you back right away if he's not busy. So I appreciate Mike for that. So anyway, Mike, thanks for letting me come in and explaining that to me. I appreciate it. It's a pretty amazing loan and definitely something I think I'm going to try and recommend to my clients a lot as we go through. So,
Awesome. Love it.
all right. Thanks, Mike. Hey, guys, thanks for watching. If you have any more questions about kind of what the real estate market is, what's going on with interest rates or mortgage rates right now, please feel free to let me know. I'm happy to help however I can with whatever you guys might need. And remember, keep in mind, in this market, who you work with matters and experience really does count. So keep that in mind when hiring or referring your next realtor or mortgage broker.
That's right.
Thanks, guys. We'll talk to you soon.
Bye-bye.